Hi, and welcome to Kuvera QuickTakes. We are speaking with Mr. Ajay Tyagi today. Ajay is from UTI Mutual Fund and he's joining us to help answer some of your questions. Hi, Ajay. Welcome to Kuvera QuickTakes.
Hi, Neelabh. Happy to be back again.
So, Ajay, jumping quickly to the question, this is a very, very common question that we receive from investors. How to handle market volatility? And, the question is, what should I do when markets are volatile? Should I not just exit from my investments when markets start going down?
Absolutely right. I think this is a very common behavior exhibited by most investors, unfortunately, sometimes even by professional investors. Let me just put this in context to you. So volatility is not something new. We've seen that markets have been volatile for centuries together, and markets will continue to remain volatile into future as well. What is it that drives this volatility? It is nothing but investors' greed on one hand and investors' fear on the other hand. Greed when people feel that trees will grow to the skies, and fear when people feel that the value of a business can come down all the way to zero. Let me just quote somebody who was Warren Buffett's professor, Benjamin Graham, who wrote a book called Intelligent Investor way back in the 1940s. And he used a phrase which actually I have actually loved reading it ever since I joined this industry 20 years back. And he described the market as a character. He personified the market by talking about a character called Mr. Market. And he says that Mr. Market is a character who's a manic depressive. On one fine day, he comes out fairly excited, fairly ebullient, and feels that, like I said, trees will grow to the skies, and he's only cheery about the business around him, the economy around him. He would continue bidding up the prices of different stocks. On certain other days, he will become absolutely despondent, absolutely frustrated with the way things are happening, and he would feel that valuations will go all the way to zero, and he would just want to sell anything and everything at any price that he can collect. When we say that markets are volatile, essentially we are talking about this manic depressive character called Mr. Market. We're talking about people who on one hand feel too excited about any particular thing, and on certain other days they basically feel that, look, everything is going to come to a naught. The fact remains that as the English saying, that truth always lies in the middle. And truth lies for those people who want to do the hard job of doing a fundamental analysis on the potential of the business, the ability of the business to continue growing as a going concern over decades and decades, and then figuring out what's the right value for that business. So while value doesn't change as much, but price keeps oscillating on both sides of the value. When markets are volatile, and by the way, when we say markets are volatile, volatility would mean prices rising higher than the value. It could also mean prices becoming significantly lower than the value. Unfortunately, when prices are rising, everybody is happy. So nobody asks this question. It's only when you're showing negative volatility and prices are only falling down, this question becomes very interesting. And I would say that, look, if it's the same business essentially, which over the long run will deliver its potential, but of course will go through its own cyclical ups and downs, then you should be buying it when the price has collapsed significantly lower than the intrinsic value. So when markets are volatile, by which I mean negative volatility, when prices are coming down, that's the best time for you to go out and take advantage of Mr. Market, because the whole market is behaving in a perverse manner and it's ready to throw out its jewels at a bargain basement price. If you are a level-headed, fundamental-based investor who can handle things with equanimity, this is the best time for you to go out and pick up these jewels at a price which is at a discount to the value. So I think I can just say this with a huge amount of conviction. Whenever prices fall, it's your time to actually go out and make some purchases and improve your long-term holding period return. Yeah.
Right. So when markets go down, buy instead of selling actually. And
Absolutely.
Actually, shouldn't an investor think of it like a sale? One would wait for sale to buy appliances for their house. In the same way, if you are getting good stocks or good mutual fund investment, an opportunity to invest in mutual funds at lower NAVs, it should just be, the psyche should exactly be the same, and why should it be any different?
Absolutely, Neelabh. I fully agree with you. You have to consider this like a sale. In fact, I would say oftentimes you see spurious sales. Genuine sales are very few. But if you look at such periods of severe correction in the stock market, and if you can actually buy into high quality businesses, it is certainly a genuine sale.
Yeah. All right, Ajay. Thanks so much for your insights today.
Thank you.